Welcome back to the Deep Dive. It is Tuesday, January 13th, 2026, and something strange is happening in the equity markets.
It really is.
The broader rally, it's fueled by a mixture of optimism, central bank liquidity, and this whole narrative around AI acceleration. But it seems determined to ignore anything that requires, well, patience, deep diligence, or a tolerance for volatility.
That's right. And nothing exemplifies that ignored category better than Novavax, ticker NVAX. I mean, this company was once the headline darling of the pandemic era. It was commanding massive valuation.
Oh, absolutely. Everyone was talking about it.
And today, sentiment has completely abandoned it. We see NVAX trading around, $7.84 a share. That gives it a modest, some might say, microscopic market capitalization of about $1.43 billion. It carries a tremendous amount of baggage and a lot of scar tissue from missed execution targets over the last few years.
Okay, so let's unpack this with a critical eye. We are approaching this deep dive with the core, foundational philosophy of legendary value investors like Benjamin Graham and Warren Buffett.
The classics.
Exactly. In the short run, the market is a voting machine. It's driven entirely by fear, greed, headlines, and sentiment. But in the long run, it's a weighing machine, measuring tangible assets, sustainable cash flows, and, intrinsic value.
And that's our job today.
Our mission today isn't to vote on Novavax's past. It is to weigh its future assets.
We need to strip away all the speculation, strip away the negative headlines that drove the stock from its highs, and really determine the intrinsic value of the business as it stands today. The central question for every listener right now is, has the market, the voting machine, punished Novavax too severely? Or is the current price a sober reflection of terminal decline?
So what does this all mean for NVAX?
Right.
We have to address the core conflict right away. Is this stock a classic value trap? Something that looks statistically cheap but is actually destined for further failure due to poor fundamentals or, crippling debt? Or is it a deep value opportunity where a genuinely high-quality asset is trading for pennies on the dollar due to a temporary, maybe even misunderstood, operational transformation?
And the answer hinges entirely on recognizing a fundamental structural change the company executed. Over the past 18 months, specifically throughout 2024 and 2025, Novavax stopped trying to be what it couldn't be. It's undergone a radical, painful restructuring.
Right.
Shifting from a heavy, capital-intensive manufacturer struggling with global logistics and sales into a lean intellectual property and licensing platform.
That structural change is the key pivot the market seems to be ignoring. I mean, the market is still fixated on old headlines about inventory write-downs and shrinking top-line revenue forecasts for 2026.
Exactly.
If the core technology, the IP, is truly valuable and management successfully transitioned the company to a high-margin model, then the market has completely missed the pivot, and we are looking at an extreme mispricing.
Precisely. If we conclude that the new structural model is durable, the cash runway is secure, and the market is only valuing the company based on its cash pile, then the weighing machine is indeed about to catch up to the voting machine. And that implies massive upside.
That's what we need to prove today.
Let's do it.
Let's start the analysis. Part 1, Chapters 1 to 3, Business, Management, and Financials.
Chapter 1. Business understanding.
To conduct a proper fundamental deep dive, we first need to answer the question, what business is Novavax actually in now, in January 2026? Because it is fundamentally different than what they were doing just 2 years ago.
It's a great question, and the simple answer is they are no longer in the global vertical manufacturing and distribution business. That's over. If you look at the old model, pre-2024, it was overly complex, incredibly capital-intensive, and frankly, structurally doomed.
They were trying to compete head-to-head with Pfizer and Moderna, right?
Yep. Exactly. Handling everything from complex antigen production to global regulatory submissions and complex cold chain logistics. They just lacked the necessary balance sheet, the experienced infrastructure, and, the scale to pull it off.
And that ambitious vertical approach resulted in
What?
a catastrophic cash burn rate?
A catastrophic cash burn rate, and it ultimately failed to generate sustained shareholder value. It just didn't work. The 2026 model, after the restructuring, is completely divorced from that failure. It's leaner, IP-focused, and centered around a high-margin licensing structure.
So what was the catalyst for that change?
The most critical event defining this shift was the strategic partnership they secured with the French pharmaceutical giant Sanofi in mid-2024. This was not merely a simple distribution agreement, it was a corporate lifeline and a fundamental strategic retreat.
A retreat, I like that.
Right.
They executed a brilliant strategic retreat and adopted what we might call an Intel inside strategy.
That's a perfect analogy. Novavax is now essentially a specialized technology provider. They provide the core components, their proprietary protein-based antigen technology, and the crucial patented Matrix M adjuvant.
And Sanofi handles everything else.
Sanofi, meanwhile, handles the entire capital-intensive, high-risk operational side, the stuff Novavax struggled with. Sanofi now takes responsibility for commercialization, logistics, and navigating the, Byzantine regulatory systems in major markets like the US and the EU.
And this partnership specifically targets the high-value 2025-2026 vaccination season and beyond.
Right.
This is a massive de-risking event, especially for investors concerned about past execution. They've intentionally traded internal execution risk, where Novavax failed repeatedly in the past, for partner execution risk.
And they're leveraging Sanofi's existing market-leading commercial dominance. That is a net positive move that dramatically lowers the company's operating expenses and increases the probability of commercial success.
Okay, so if they gave up manufacturing and logistics, what is left? What gives Novavax the power in this partnership? You mentioned the technology.
It is the technology itself, and specifically the true economic moat. The Matrix M adjuvant. This is the crown jewel. This is the whole game.
Tell us more about the moat. For our listeners who might be familiar with vaccine mechanics but not this specific technology, what is Matrix M and why did Sanofi cut a check for $500 million upfront just to secure access to it?
Okay, so Matrix M is a saponin-based adjuvant. To simplify, an adjuvant is a component added to a vaccine that is designed to amplify or boost the immune system's response to the antigen, the harmless piece of the virus or bacteria you are trying to train the body to recognize.
Right, I've heard of adjuvants like alum.
Exactly. Traditional vaccines often use adjuvants like alum, which are effective but sometimes limited. Matrix M is far more potent.
Potency means higher efficacy, but the outline mentions a key economic feature, antigen-sparing capability. That sounds like a technical term for something much more important in the world of high-volume vaccine production.
It is the economic killer app. Antigen sparing means you can achieve the necessary level of immune response, the protective antibody titers, using a significantly smaller amount of the raw vaccine material, the antigen, per dose.
Okay, so why is that critical?
In a high-volume scenario where raw materials are often bottlenecked or expensive, this capability allows a manufacturer to produce maybe 2 to 3 times as many finished doses from the same raw material supply.
So it lowers the cost of goods sold. The Cauchy S per dose dramatically and radically increases production efficiency and scalability. It just makes the Novavax platform much cheaper to mass produce than a non-adjuvanted vaccine.
Exactly. And the true validation of this asset didn't come from Novavax management writing an optimistic press release. It came directly from Sanofi's checkbook. They paid $500 million upfront in May 2024 and committed up to $1.2 billion in total milestones to secure access to Matrix M and the platform for combined vaccine development.
That upfront payment alone is nearly 1/3 of the current market cap, just to get access to the tech.
Just to get in the door. And the validation didn't stop there. We saw a crucial development in late 2025 where Sanofi actually expanded the license.
Oh, interesting. For what?
They want to use Matrix M in their pandemic influenza vaccine candidate. That candidate, notably, is a program funded by BARDA, the Biomedical Advanced Research and Development Authority.
So a key component of the U.S. government's pandemic preparedness strategy.
That's the one. When you have a top-tier global pharmaceutical giant and a major U.S. government agency betting on your technology for future multi-billion-dollar programs, you have confirmation that Matrix M is not just niche tech. It is a verified, durable, competitive advantage protected by intellectual property that extends well into the 2040s. The moat is real.
Okay, let's discuss the shift in revenue quality, because this is the critical point that seems to have confused the market and caused this mass exodus from the stock. We're seeing these frightening headlines that 2026 revenue is forecasted to decline sharply down to what, 185 million to 205 million, excluding the amortization of the Sanofi upfront payments.
This is where we need to apply the weighing machine filter and ignore the superficial headline. The key is to look at the margin profile of the revenue, not just the gross quantity. That decline in the top line is not a failure, it's intentional.
So what are they doing?
They are actively trading what we call low-quality revenue generated in 2024 and 2025 that came with crushing high costs of goods sold, massive marketing expenses, and significant inventory risk for what we define as high-quality revenue.
Meaning near 100% margin royalties.
Precisely. The milestone payments and future royalties, which make up that forecasted 185 to 205 million trough number, fall almost straight to the bottom line. They bypass the entire heavy infrastructure, sales force costs, and complex operational costs they used to incur.
So while the 2026 top-line number looks small when compared to the pandemic-fueled peaks, the potential profitability and efficiency of that revenue are orders of magnitude higher.
Exactly. This is a deliberate retreat to profitability.
Shifting to the future, the pipeline. The immediate future rests heavily on the success of the COVID-influenza combination, or CIC, vaccine. Sanofi initiated phase 3 trials for this combination product in late 2025, and this is the first major test of the partnership.
This is truly the massive near-term market opportunity that justifies the valuation. I mean, we've all seen it. There's palpable consumer fatigue regarding receiving multiple standalone boosters for flu and COVID-19.
What do you want, 2 shots?
Nobody wants 2 shots. The market is consolidating around the demand for a single, convenient annual shot. The challenge for the mRNA vaccines, which have dominated the COVID space, is that they have sometimes struggled with reactogenicity or side effects when combined into multivalent shots, particularly in older populations.
And this is where the Novavax protein-based approach shines, leveraging that matrix M adjuvant.
Exactly. Their protein-based vaccines have historically shown a significantly more favorable safety and tolerability profile compared to mRNA products. When this superior tolerability is combined with Sanofi's Fluzone franchise, which is already a market leader in seasonal flu,
You get a potentially best-in-class product for that single-shot market.
a formidable one. The regulatory path is clearer, and the commercial infrastructure, Sanofi, is ready to go.
And what's the financial reward if they succeed?
If approved, which would be a massive catalyst, Novavax is eligible for mid-single-digit royalties on sales of these combination products. Critically, because Sanofi handles everything, this revenue stream is sticky, high margin, and defines the sustainable financial model of the new lean business.
Okay, let's talk about the operational streamlining, the painful but necessary cigar butt cleanup, as the sources referred to it. This really demonstrates management's commitment to right-sizing and surviving.
The sale of the massive Czech Republic manufacturing facility to Novo Nordisk is a textbook example of excellent strategic capital allocation in a distressed environment. They secured $200 million in total.
How's that broken down?
$190 million received in 2024 and the final $10 million in 2025. This was crucial, non-dilutive capital.
But wasn't selling a key manufacturing asset a sign of failure? I mean, I could see how many investors saw it as management throwing in the towel on their global ambitions.
That's the classic short-term voting machine reaction, which we must challenge. Selling the asset was a recognition of reality. The genius of the move isn't just the $200 million cash infusion, it's the cost removal.
Right.
That sale eliminated approximately $80 million in annual operating costs. Salaries, maintenance, utility bills, depreciation from the company's books, permanently lowering the cash burn rate. A failed company clings to assets. A successful turnaround monetizes them and cuts the cord.
And that wasn't the only aggressive cost-cutting. They also consolidated the Maryland headquarters.
Right. That generated another $60 million in cash and projects an additional $230 million in future cost savings over the next 11 years.
So these moves confirm the business analysis conclusion. The operational risk is fundamentally shifted. Novavax is no longer bogged down in manufacturing or sales execution, which were their historic weaknesses.
No. They are focused entirely on maximizing the value of the Matrix M platform, while Sanofi shoulders the commercial burden. This is a fundamentally lower risk profile, even if the absolute revenue numbers appear smaller today.
Chapter 2. Management Evaluation.
A turnaround story is only as successful as the leader navigating it. We have to evaluate CEO John C. Jacobs based on his performance during this critical 2024-2025 window. We're primarily looking at his capital allocation decisions and strategic agility.
Right. I mean, Jacobs inherited a collapsing structure, a bloated infrastructure built for peak pandemic demand that had violently evaporated.
Yeah.
Any leader in that situation needs to demonstrate pragmatic ruthlessness. His performance has to be judged on how quickly and effectively he stabilized the balance sheet and lowered the company's structural break-even point.
Absolutely. And the sale of the Czech facility is the single most compelling piece of evidence for this pragmatism.
My concern, however, is that selling off core assets sometimes leads to the critique that management is simply shrinking the company to eventual irrelevance. How do we trust this team going forward?
That is a fair challenge, and it distinguishes a strategic move from a desperate fire sale. If they sold the manufacturing, but kept the enormous payroll or failed to secure a partner, it would be a failure. But they didn't. They monetized a distressed asset for $200 million while simultaneously removing $80 million in annual fixed costs.
That timing was key.
It was everything. This secured essential, non-dilutive capital precisely when the company was facing potential insolvency, effectively buying them a multi-year runway. This wasn't brilliant arithmetic, it was brilliant survival.
The Maryland consolidation further proves this commitment to right-sizing. A weaker management team, or one driven by ego, would have resisted these moves to maintain the illusion of being a global, vertically integrated player. Jacobs demonstrated the humility to admit the commercial strategy failed and focus on the company's sole, unique strength, its IP.
And we can connect the dots by looking at the density and consistency of key decisions made in that high-pressure 2024-2025 timeline. It shows a consistent, methodical strategy under fire.
Let's walk through that timeline to appreciate the strategic difficulty involved in orchestrating these complex deals simultaneously.
It's relentless. The Sanofi deal was inked in May 2024, providing the initial $500 million cash cushion that gave them negotiating power to pursue the factory sale. The initial $190 million cash from the Czech sale followed in late 2024.
Okay.
They then hit a pediatric milestone in December 2024 for $50 million. Throughout 2025, they executed against the Sanofi terms, achieving another $225 million in total milestones.
And then Maryland.
And finally, the Maryland consolidation in October 2025 brought in another $60 million in cash.
That sequence tells the story of survival. It wasn't one stroke of luck. It was a consistent, methodical strategy to shore up cash reserves, stabilize the balance sheet, and aggressively cut overhead, all while securing a partnership that validates the core technology.
And we must address the Shaw Capital episode, because this speaks directly to Jacobs' strategic leadership under conflict. Activist investor Shaw Capital, holding over 7% of the stock, was openly critical of the rollout failures and advocated for board and leadership changes.
In this high-stakes scenario, a CEO often commits capital and time to fighting a long, draining proxy war to save face. Jacobs avoided that.
He essentially validated the activist thesis, but implemented the solution pragmatically. The activist thesis was correct. Novavax had superior technology but disastrous commercial execution.
So instead of fighting them,
By securing the Sanofi deal, Jacobs tacitly admitted that commercial weakness and leveraged a partner's strength to solve the problem rather than fighting the investor. This strategic, humble response, prioritizing securing the company's future over winning a boardroom fight, is a strong positive signal for a turnaround effort.
we also look for proper incentive alignment. How was Jacobs compensated during this critical phase?
The 2024 bonus structure was tied directly to key turnaround metrics. Financial health improvement, specifically OPEX reduction, had a 20% weight, and portfolio advancement, which was quantified by the success of securing the Sanofi deal, had a 28% weight.
And the board felt he delivered.
The board determined he exceeded those goals, awarding 107% of his target bonus. This confirms alignment with shareholder survival metrics. We want management focused maniacally on return on invested capital, ROIC, and cash preservation, not on pursuing top-line growth at any cost, which was the previous leadership's mistake.
Okay, finally, let's briefly touch on insider activity.
Yeah.
We did note some routine insider selling in late 2025 and early 2026, including some shares sold by Jacobs himself. While this is often related to pre-scheduled tax vesting codes, it's never comforting in a deep value situation where management should ideally be accumulating shares.
It is important to differentiate routine, structured, tax-related sales, which are common in compensation plans, from a catastrophic, massive dump suggesting a loss of faith. The selling appears structured, and crucially, the institutional ownership, which we will analyze later, has remained stable. The management team overall is playing a difficult hand with competence and demonstrable skill.
Okay, successfully retreating from the commercial war to focus on high-margin IP licensing.
That's the story.
Chapter 3, Financial Health.
Now we arrive at the core of the analysis, the financials and the margin of safety. Benjamin Graham famously defined the margin of safety as buying a dollar's worth of assets for significantly less than a dollar.
And let's start with the balance sheet, because in a turnaround, cash is the only thing that matters.
It's everything. At the close of 2024, Novavax reported $938 million in cash, cash equivalents, and short-term marketable securities. This represents the critical cash floor. The core investment question for 2025 was simple. Did management successfully staunch the bleed, or did they burn through that entire cash floor?
We need to analyze the 2025 cash bridge figure in detail. Let's look at the inflows first. They had 225 million in earned Sanofi milestones, which represented real operational cash.
Uh-huh.
They also had approximately 70 million from the strategic property sales, combining the final check installment and the Maryland consolidation cash proceeds. That's roughly 295 million in planned strategic cash inflows for 2025.
And this is where the cost-cutting proved effective. On the outflow side, we estimate the operational cash burn covering R&D, retained G&A, and minimal remaining commercial efforts was approximately 295 million.
So they balanced out.
If you look at the bridge figure, the strategically generated cash inflows effectively neutralize the estimated operational cash burn for the entire year.
That is a staggering achievement. They started 2025 with 938 million, and through disciplined management and successful execution of milestones and asset sales, they are estimated to end 2025, entering January 2026, maintaining approximately 900 million to $1 billion in liquidity.
Right. They transform the business model without burning down their cash pile.
This leads us directly to the enterprise value implication, which is the most striking data point supporting the deep value thesis. The current market capitalization is roughly 1.43 billion.
Okay.
If we take our estimated cash floor of conservatively $1 billion and subtract it from the market cap, the enterprise value, the value the market is placing on the operating business after accounting for its own cash, is only about 430 million.
Wait, hold on, let me challenge that figure. If the market is genuinely placing an enterprise value of only 430 million, what massive unstated liability, off-balance sheet debt, or catastrophic contractual penalty is the market pricing in that we are ignoring?
That is the right question, because the market rarely prices things this low without a reason. The primary fear priced in is the execution skepticism, the fear that the remaining 350 million in deferred compensation and potential debt will overwhelm the cash flow.
So they just don't believe the cash number is real.
They think the 1 billion cash number is actually overstated due to inventory quality or hidden payables. However, the audited balance sheets and forward guidance suggest the 1 billion cash floor is stable. The market is pricing in the probability of failure.
That the combination vaccine will fail, making all future IP values zero, and the company will slowly burn the remaining cash to nothing.
So assuming the cash floor holds, the market is valuing the entire operating business, including the massive Sanofi deal, the proven Matrix M adjuvant platform, the entire combination vaccine pipeline, and IP protection into the 2040s at roughly $430 million.
It implies extreme undervaluation if the transformation holds up. It suggests the market is assigning the IP value at a tiny fraction of what Sanofi alone paid up front just to get their foot in the door.
This brings us back to the misleading revenue figures, the core confusion point.
Yes, the accounting complexity. 2025 revenue was forecasted high, around $1.05 billion. This number created the illusion of success, but it was largely generated by GAAP accounting that requires the company to recognize the $500 million Sanofi upfront payment as non-cash deferred revenue amortization over a fixed period.
So it wasn't real commercial sales driving that number.
Exactly. And now, the market is panicking over the 2026 guidance, which is projected to trough at 185 to 205 million. Investors, fixated on top-line growth, see a massive collapse.
But you're saying this low number represents actual high-quality, high-margin revenue.
Correct. Milestone and royalty payments, excluding that non-cash amortization noise. It represents the lowest projected revenue before the high-volume combination vaccine royalties kick in meaningfully. This is the necessary trough in the pivot cycle, not a sign of death.
And crucially, they've lowered the profitability hurdle dramatically. The annual cost reductions, 80 million from the check sale, plus another 20 million projected from Maryland, totaling 100 million in structural annual savings, mean the company does not need to hit the multi-billion-dollar revenue numbers it once did just to reach profitability.
They've rationalized the cost structure to match the anticipated high-margin royalty streams. They've successfully lowered the goalposts for long-term viability.
Let's run a quick sum-of-the-parts analysis to define the intrinsic value we're weighing against the current price. We need to create at least two scenarios to risk-adjust these assets.
Okay, so we start with our reliable base asset, liquidity, about $1 billion in cash and equivalents. Next, we factor in the risk-adjusted milestones. Novavax is eligible for up to 350 million remaining for phase 3 CIC development and launch, and up to 200 million per new vaccine Sanofi develops using Matrix M.
Let's define scenario 1, the conservative case. In this scenario, we assume the CIC phase 3 trial succeeds, but future expansion is highly limited. We'll apply, say, a 70% probability of success to the 350 million CIC milestones,
Okay, so that's 245 million,
and only a 10% probability to any further 200 million expansions.
worth another 20 million.
So in the conservative case, scenario 1, we have cash at 1 billion plus risk-adjusted milestones of about 265 million, equaling 1.265 billion in net value. The market cap is 1.43 billion.
This suggests the market is assigning only 165 million to the entire long-term royalty stream and the IP platform. That's a massive discount.
Now let's define scenario 2, the base case. We assume high probability of CIC success and moderate success for 2 other Matrix M expansion programs by Sanofi. Let's apply an 85% probability to the 350 million CIC milestones,
So that's 297.5 million.
and a 40% probability to 2 separate 200 million expansion milestones.
So another 160 million. In the base case, we have cash at 1 billion plus risk-adjusted milestones of about 457.5 million, totaling 1.457 billion.
And that value exceeds the current market cap.
Right. And we haven't even factored in the present value of the actual high-margin future royalties from product sales themselves, only the developmental milestones.
This analysis implies that the Matrix M platform, the entire combination vaccine pipeline, and all future high-margin royalties are being assigned a value of roughly 0 or even negative value by the current market price. The valuation disconnect is staggering.
And this disconnect is why analyst price targets vary so wildly. I mean, some highly optimistic models are running intrinsic values based on peak royalty projections as high as $41 per share.
Okay, that's very aggressive.
Very aggressive, but even the more conservative Wall Street firms are seeing the opportunity. Cantor Fitzgerald, for instance, has maintained a sober but highly bullish $18 price target. That suggests more than 100% upside from the current $784 level, simply based on the CIC success and the secure cash position.
So the market remains uncertain because it is misreading the structural pivot and the negative headline from the 2026 revenue guidance.
That's the thesis.
Like and subscribe to Stock Analytics AI.
Apologies to all members. We have been demonetized by YouTube for repetitive content. They clearly don't understand what we are doing here. The good news is that we are going to continue. For members, sign up at stockanalytics.ai, and within the next few weeks, we will upload access to the full 600 videos for the S&P 500 and NASDAQ 100 and the coming 100 top AI stocks of 2025, $5 per month. And we will begin adding more features to the web application by the week, so joining early will be a great advantage.
Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
We must now assess the mood of Mr. Market, using Graham's analogy. And right now, Mr. Market is suffering from severe depression regarding Novavax.
He's incredibly pessimistic. He is pricing in failure, offering to sell us the company at a rock-bottom price that reflects maximum possible fear.
The single clearest quantitative indicator of that pessimism is the high short interest. For our listeners who may not track these technical indicators daily, detail the magnitude of this short position.
As of early January 2026, there are over 50 million shares sold short. This is not a trivial number. That volume represents approximately 39% of the entire tradable float.
39%.
To put that in perspective, any short interest above 10% is usually considered high. 39% represents a massive, overwhelming bearish bet against the company's survival. The bears are betting that the stock will eventually fail or need a dilutive capital raise near zero.
That is enormous. What exactly is the bearish thesis that is driving such a significant short position? They must believe the $1 billion cash floor is fictional.
The short case rests on 3 main interconnected pillars. First, the execution skepticism we discussed, the historical scar tissue. Bears argue that Novavax management has such a long track record of missing deadlines and regulatory filings that they cannot be trusted, even with Sanofi's help.
So they think Sanofi will get fed up.
Exactly. They fear that even Sanofi might deprioritize the CIC program, given the difficulties Novavax has caused historically.
What's the second pillar?
They believe in the vaccine market shrinking to commercial irrelevance. The bears argue that while COVID-19 is endemic, the demand for annual shots will stabilize at a much lower, more competitive level than Novavax needs to survive.
So the pie isn't big enough.
They argue that the combination vaccine market is not a multi-billion-dollar opportunity, but a highly fragmented one where Novavax's single-digit royalties won't sustain the company.
And the third, the most destructive one, must be the cash burn scenario.
Correct. They believe that even the reduced cash burn rate, estimated at around $295 million annually, will eventually exhaust liquidity before the high-margin royalties from the combination vaccine kick in meaningfully. They believe the company will be forced to execute a highly dilutive capital raise
Selling shares at depressed prices.
in 2026 or 2027, severely impairing existing shareholder value and making the current price irrelevant.
But high short interest, as value investors understand, is a double-edged sword. While it signals immense bearish pressure, it also creates an enormous technical opportunity.
Absolutely. It creates enormous technical upside pressure. If Novavax announces positive news, say a successful CIC Phase 3 readout, hitting another major Sanofi milestone, or even better, an FDA approval timeline acceleration, it acts as a powerful catalyst for a short squeeze. Those 50 million shares sold short must be eventually bought back. If news forces even a fraction of those shorts to cover their positions simultaneously, they will bid the price up significantly, possibly far past the intrinsic value calculation. This high short interest suggests the stock is currently priced at a cyclical bottom defined by pure maximum fear.
The analyst divergence further confirms this opportunity. We noted the bulls like Cantor Fitzgerald maintaining a firm $18 target, often based on a more realistic view of the CIC market potential.
And conversely, we have the neutrals and bears publishing targets in the $6 to $10 range, often focusing exclusively on the near-term cash burn risk and historical failures.
So this massive spread, the disagreement between sophisticated analysts who have access to the same sources, is precisely what creates the opportunity for mispricing.
If everyone agreed on the true value, the stock would already be trading there.
The price action confirms the pessimism. Trading near its 52-week lows, in the 501 to 1064 range, the stock has effectively round-tripped to pre-pandemic valuation levels. The market is pricing the company as if the entire strategic partnership, the structural pivot, and the Matrix MIP are worth nothing.
It's a slowly burning pile of cash that is destined to run out.
Chapter 5. Ownership structure.
When analyzing a messy turnaround, we must look at who is holding the stock. Who are the co-investors here? We want to see stability and quality in the shareholder base as they act as a buffer against volatility.
And what do we find?
We find surprisingly strong stability. Despite the volatility, the institutional heavyweights have maintained substantial positions, often because NVAX remains part of various passive indices. Vanguard holds 9.35% ownership. BlackRock holds 7.86%, and State Street is at 4.43%.
These are the index fund giants. Their presence provides passive but substantial liquidity and confirms the stock has not been disqualified from major indices, which is a crucial checkmark for long-term holders.
Then we have the active watchdog, Shaw Capital. They own roughly 7.8% of the company. As an activist investor, they are committed to ensuring management continues its focus on unlocking value, primarily through cost reduction and smart licensing.
So they're an asset, really.
For us, this stakeholder acts as an asset. They ensure management remains focused on ROIC and shareholder value creation, providing oversight that passive investors often lack.
But the single most important element of the ownership structure, and one that fundamentally alters the risk profile, must be Sanofi's strategic alignment.
Absolutely. As part of the 2024 deal, Sanofi took a minority equity stake in Novavax, a position that represents less than 5% but is strategically crucial. Sanofi is now a shareholder.
And that matters.
It matters a lot. They have a vested financial interest in Novavax's successful survival and valuation appreciation. More importantly, they need Matrix M for their own multi-billion-dollar pipelines, specifically the CIC vaccine and their critical BARDA-funded pandemic flu candidate.
So Sanofi essentially acts as a strategic safety net, mitigating the terminal risk. They are highly unlikely to allow their sole, key supplier of this proprietary patented adjuvant platform to fail, fall into bankruptcy, or be acquired by a competitor.
Allowing that would severely jeopardize their own long-term multi-billion-dollar vaccine programs.
Precisely. This structural alignment significantly limits the catastrophic downside risk for the common shareholder. The cash floor protects the balance sheet from operational failure, and Sanofi's stake protects the operational continuity and IP from commercial or financial collapse. It's an effective two-layer protection mechanism.
Chapter 6. Risk Assessment.
We've established the margin of safety based on cash and valuation and the strength of the strategic pivot. Now for the most important part. The brutally honest assessment of risk. What could permanently impair capital? We need to run a rigorous SWOT analysis. Strengths, weaknesses, opportunities, and threats.
Let's start with the strengths, because these are durable, high-quality assets that have survived the downturn. First, the Matrix M adjuvant is validated, patented technology with IP protection extending into the 2040s. That is the core, irreplaceable asset.
Okay.
Second, we have the strong cash position, $1 billion in liquidity relative to a $1.43 billion market cap, providing a multi-year runway. Third, the Sanofi partnership successfully offloaded massive operational, manufacturing, and commercial risk, which was the company's biggest failure point.
On to the weaknesses. The internal issues management still needs to overcome to achieve consistent profitability.
The primary weakness is single product dependency. Even with diversification efforts like the ongoing malaria program, the near-term future and the entire turnaround thesis relies heavily on the success and commercial uptake of the COVID-flu combination franchise.
And they're not profitable yet.
Second, they are not yet GAAP profitable. The cash bridge must hold, and they must execute the remaining cost savings and hit profitability before the royalty stream is exhausted by the residual operational burn. And third, the historical reputation, the scar tissue of missed timelines, must be fully healed by Jacobs' continued strong execution on the Sanofi milestones.
Now let's look externally at the opportunities. What are the catalysts that will drive value realization in 2026?
The combination vaccine, the CIC success, is the biggest opportunity. A positive phase 3 readout would trigger immediate significant milestones over $125 million and accelerate the flow of the high-margin royalty revenue.
And beyond that.
We also have pipeline expansion optionality. Matrix M can be licensed for other diseases like shingles, RSV, or malaria, generating high-margin cash flow without Novavax having to expend its own capital or R&D budget. And finally, the high short interest provides the immediate technical upside for a powerful short squeeze on any definitive positive news.
And now the threats. These are the external factors that could genuinely kill the thesis and cause permanent capital impairment. Looking at the risk matrix, what are the two highest impact threats we need to monitor daily?
The two highest impact threats are partner performance and regulatory risk. First, partner performance. Novavax is now completely dependent on Sanofi's ability to execute, prioritize, and successfully commercialize the combined vaccine program.
So if Sanofi drops the ball,
if Sanofi faces unexpected internal delays, shifts priorities to a different pipeline asset, or fails to gain market traction with the CIC, Novavax lacks a robust plan B for distribution in major markets. This is the new, highest source of operational risk.
and regulatory risk, particularly concerning the CIC Phase 3 trial and final FDA approval. The FDA can be unpredictable, especially with novel combination products.
Exactly. If there is any unexpected safety signal, even a minor one, or a major regulatory hurdle regarding the combination vaccine trials, the market would instantly devastate the stock. Given the high short interest, bad regulatory news would immediately wipe out the perceived value of the pipeline, forcing the stock to trade almost exclusively on its cash floor.
And that would severely impair the current market cap. We also need to acknowledge the macro context of 2025-2026. The sources highlighted escalating tariffs and trade tensions, especially impacting global supply chains and biopharma.
And while Novavax has shed its own manufacturing assets, its partners, including Sanofi, are not immune to macro risks. Tariffs on imported raw materials or trade tensions affecting global cold chain and supply lines could squeeze partner margins or delay production timelines. This is a high likelihood, moderate impact risk that needs monitoring.
Even though NVAX's balance sheet is less directly exposed than it was 2 years ago.
We are now dependent on Sanofi's global risk management.
Chapter 7. Conclusion.
We have dissected the transformation, scrutinized management's survival instincts, and weighed the intrinsic assets against the liabilities. Let's return to the core question posed at the start of this deep dive. Is Novavax a value trap or a deep value opportunity?
Let's summarize the evidence that overwhelmingly supports the deep value opportunity thesis. First, asset value. The company is currently trading slightly above a $1 billion cash floor, implying the market assigns zero or near zero value to the long-term, high-margin IP and royalty streams.
Despite our SOTT analysis suggesting at least $1.265 billion in conservative value.
Second, the moat. The Matrix M adjuvant is confirmed, durable, and protected by patents into the 2040s. Its value is validated not just by internal science, but by the $500 million upfront payment and the crucial strategic equity stake taken by Sanofi.
Third, management. CEO Jacobs has demonstrated pragmatic, necessary leadership, focusing entirely on survival, rationalizing assets, cutting bloated costs, and prioritizing a favorable ROIC profile over unsustainable commercial scale.
He executed a strategic retreat that secured the company's financial future.
And fourth, the catalysts. There are clear near-term events, primarily the CIC Phase 3 readout, FDA submission, and ongoing milestone payments set to unlock value in 2026 and force the market, the voting machine, to finally reconsider its pessimistic valuation.
And so we put Novavax on the weighing machine. And what is the final verdict?
Novavax represents a classic asymmetric value play for the patient, diligent investor. The downside is heavily protected. The strong cash floor and the strategic commitment of Sanofi limit the risk of permanent capital impairment or bankruptcy. The upside, however, is massive optionality stemming from the successful commercialization of the combination vaccine.
So the company's executing its survival strategy, while the market is still fixated on pricing and its previous failure. The voting machine says sell now, ask questions later.
And the weighing machine, after our analysis, suggests a strong buy, assuming acceptable management of the critical external risks.
Here is the final provocative thought for you to consider, and the source of the greatest long-term valuation potential. The market is currently obsessing over the shrinking COVID flu dynamics and the negative 2026 revenue guidance.
But the true long-term value might lie entirely outside of COVID.
Where does the long-term value truly reside then?
In Matrix M becoming the industry's standard adjuvant platform, Sanofi or other future partners could develop multi-billion-dollar vaccines for other massive, untapped disease markets, think malaria, which the company is already progressing on, or lucrative markets like RSV or shingles, all utilizing Novavax's IP.
And Novavax, having shed all the heavy manufacturing and commercial risk, simply sits back and collects royalties.
High-margin royalties into the 2040s. This complete transformation into a pure, high-margin IP cash machine is what the current depressed, fearful price misses entirely, offering enormous upside optionality that is effectively free.
A fascinating deep dive into a company that has successfully navigated the turn, even if the market hasn't noticed yet. We appreciate you joining us for this rigorous analysis. Like and subscribe to Stock Analytics AI.
Apologies to all members. We have been demonetized by YouTube for repetitive content. They clearly don't understand what we are doing here. The good news is that we are going to continue. For members, sign up at stockanalytics.ai, and within the next few weeks, we will upload access to the full 600 videos for the S&P 500 and NASDAQ 100 and the coming 100 top AI stocks of 2025, $5 per month. And we will begin adding more features to the web application by the week, so joining early will be a great advantage.
A quick reminder, this information is based solely on AI research and curated sources and is strictly for informational and educational purposes only. This is not financial or investment advice. You must always conduct your own due diligence and consult a financial professional before making any investment decision.
Thank you for joining us for this deep dive.
We'll be back soon with more insights from the cutting edge of finance and strategy.